If you operate a fleet of 5 to 50 trucks and you're constantly wondering how these insurance companies determine the rates that they're going to charge you, this video is for you. What's going on, guys? Ben here, owner and CEO of Strong Insurance. Today we are going to break down some of the key factors that insurance companies utilize to determine the rates that they charge your fleet. So right out of the gate, we have three primary categories we're going to tackle today. We have safety history, drivers and vehicles, and operational discipline. So the first piece to safety history right out of the gate is one everyone knows. It is the loss history. These insurance companies are a for-profit business just like you or I. They need to be able to make money. So when it comes to looking at loss history, there's a few different things that these insurance companies are going to look at. First is your loss ratio. What is a loss ratio? We're just going to use simple numbers here. Say you're a small fleet operation and you pay $100,000 a year for your insurance. Let's say in the last 3 to 5 years, depending on how far the look back period is for the specific carrier you're marketing to, let's say they paid out $65,000 each year on average in claims. So we're just going to look at a 1-year average and say, okay, so they paid out 65%. That is typical break-even point for most of these insurance companies. That's if you're over 65% on 3 to 5 years worth of insurance history, you're a lot less likely to get preferred and favorable rates. Now, you look at 65% and say, okay, well, they made $35,000. They should be jumping over the moon. Well, you got to understand that is just in the total incurred that's been paid out by them, essentially. They still have their overhead just like you or I. They had the underwriter who underwrote the account, the service person who made the changes throughout the year to that account, and any time spent by claims adjusters, all of what we call desk time. There's plenty of desk time involved. Now, heaven forbid that they had to defend you in any sort of legal matter. Now we have legal fees that they've paid on your behalf also included in that. So 65% leaves them 35%, and they use that 35% to operate. So that's typically the cutoff point. So loss ratio is one of the primary key factors. Second key factor when it comes to losses is loss frequency. The more claims you're turning in and the more often you're turning them in, the less desirable your account becomes as well. One of the primary things we see here is someone may have a really good loss ratio of maybe they only paid out $30,000 on average over the prior 5 years, and it's all roadside assistance claims. To me, that instantly indicates that you're using roadside assistance as a fleet maintenance backup instead of maintaining your fleet. That's not going to look good to an insurance company or an insurance carrier. Likewise, any of the other frequency issues, if you're constantly in accidents, constantly having cargo issues, obviously those are going to be red flag determinations for the insurance carrier. So outside of losses, we're also going to look at your Central Analysis Bureau report. There are other reports out there that some other carriers utilize and some other agents utilize. There's your Central Analysis Bureau, which is the most widely known. There's your Blue Wire report. There's a carrier software report. Most of them are touching on many of the same data points. So we're looking at, in a cab, for example, we're looking at 7 primary categories, ensuring that you're under threshold. We're looking for the least amount of cab alerts as humanly possible. And then obviously your out of services and your inspections. The higher your out of services and inspections and the higher your cab score, the lower or the less likely you are to get preferred pricing from an insurance carrier. So let's move on to drivers and vehicles and fleet and kind of what happens here. So when it comes to drivers, right out of the gate, there's some huge eligibility concerns that can negate you from going with some of the more preferred insurance carriers. Typically, these insurance carriers do not want you to have any drivers under 23 years of age or any drivers who don't have 2 years of USA CDL-A experience. Occasionally, a carrier will accept Canadian CDL experience or Mexico CDL experience. Rarely, if ever, will they accept European CDL experience. So Those are the primary criterias. Anytime that you have a driver who maybe falls outside of that criteria is usually going to increase your premium. Some carriers won't insure you at all. Others will adjust your premium accordingly. You're much more likely to get away with maybe a young driver or a lesser than experienced driver if you've got a fleet of 50, 80, 35 trucks even, and maybe one or two lesser than experienced drivers or drivers that fall underneath the age of 23. On the flip side, you can also run into issues when you have multiple drivers or too many drivers over the age of 65. That can also become an issue. When it comes to vehicles, newer vehicles are always going to be helpful in determining rate. They just have more safety features involved with them. If you're looking at reefer, being newer than 10 years old or at least having maintenance records to show that the reefer unit itself has been recently repaired or overhauled, that will certainly help your ability to obtain better rates as well. Now, operational discipline, it's going to kind of all culminate to operational discipline. One thing we're looking for here is we want drivers that have been with you for a long time. How do you get drivers that stay with you for a long time and keep that good longevity and get that tenure? You make sure you have driver hiring practices in place, that they know what they're getting when they come to work for you, and you know what you're getting from them when you hire them. We want to make sure that you have good onboarding practices. For those drivers that are already onboarded and working for you, we want to make sure that they're aware of the pre-trip inspection requirements that you've put forth in writing. If you have post-trip checkups, we want to make sure that that's in writing and they're aware of how to use those. So any sort of written safety provisions that you can have from a driver standpoint, onboarding, pre-trip, post-trip, drug testing, any sort of written provisions is certainly going to help your case. Same thing on the fleet maintenance side. If you have a required fleet maintenance written provision that says at this interval, this happens, at that interval, that happens, and it gets followed, they're only as good as the paper they're written on if they don't get followed. But if you have these provisions in place and it gets followed, give them to your agent when it's time to market your account. It definitely helps in their ability to go to underwriting and say, look at how well this fleet has their poop in a group. We really want to work with them. They've got good loss history. They've got good provisions and making sure that all their T's are crossed and I's are dotted. This is an ideal client or an ideal fleet to work with. The last thing is obviously any sort of electronics, logging devices and telematics that you can offer to the insurance company, whether you have forward-facing cameras, forward and inward-facing cameras, outward-facing cameras with AI technology, up-to-date electronic logging devices that can be integrated with your insurance carrier. I know we're going to link a video down below this one about the importance of why connecting ELD is just so important anymore. It's becoming the way of trucking insurance. It almost always is going to help you. It's going to get you discounts. Sharing that data is becoming ever important. So having those operational disciplines in place is certainly going to help your case in reducing your premium. So if you're tired of guessing what's causing your renewal to increase year over year, give us a call here at Strong Insurance. We'd love to look at what you're currently submitting to the market, making sure that all of this stuff is in order, 60, 90, 120 days prior to your next renewal. Get you geared up to go to the marketplace and present the most beautiful tied up with a bow package to these carriers to make sure you get the best rate possible. Additionally, if you want to continue to learn more about the trucking insurance industry or the trucking industry as a whole, please give us a like, follow, and as always, keep it rubber side down.